After a horrific day for the averages, look, it was all the delayed reaction from yesterday's Fed meeting. It's more important than ever to look back on the past year and see what worked. Which stocks managed to go higher in the face of relentless rate hikes, fears of a slowing economy. All week, we've been highlighting the best performing stocks, the S&P 500, and their components. We've been through energy, the utilities, and the consumer staples, although after today's beatdown, only energy and utilities are up for the year. Next up, though, is healthcare, which is down just over 2% for 2022. What a year that we have to celebrate the companies that are only down 2%. We don't want to paint with too broad a brush when it comes to healthcare because there are 64 of these stocks in the S&P 500, and they don't necessarily have that much in common. This year, Wall Street's been very receptive to some subgroups and very hostile to others, and that's why the best-performing healthcare stock is up more than 50% for the year, while the worst performers down roughly 70%. Think about it. Healthcare captures everything from insurance companies to hospital operators, medical device makers, the whole range of drug makers. Even within drugs, there's a huge difference between big pharma, these are established companies with enormous earnings, and smaller biotech outfits, which tend to be a lot more speculative. Many of them don't have any sales, let alone earnings. At this point, regular viewers know what this market wants because we've had a year to get used to the new formula. Wall Street likes profitable companies with consistent results, nice dividends, and reasonably valued stocks that make things and do stuff. All right, big pharma in a nutshell, right? Which is why 3 of the 9 best-performing healthcare stocks in the S&P were pharma. There was Merck. How much we like what they're doing, especially with the vaccines. Eli Lilly is looking weight loss there, and Bristol Myers with an amazing cancer franchise. On the other hand, while the larger biotechs behave more like big pharma, the smaller ones feel more like the speculative stocks. They trade based on their future prospects many years down the road, which makes them a lot less attractive when inflation is raging and interest rates keep rising. Just like every other sector, the high multiple growth-oriented healthcare stocks got obliterated this year. Whether we're talking medical device or the life science arm dealer or the veterinary medicine stocks, this has been really good for a long time. Or something like Align Tech. That was the worst performer in the group. I don't know. Most of my friends have Align. You know, the stuff, well, you can't see it. I don't have it. Meanwhile, the biggest winners were boring, consistent operators with cheap stocks.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.